Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 257th podcast VideoCast for the week ending September 17th, 2024. We're doing it 2 days early this week. I had two choices, either do it today on Tuesday or all the way on Friday, and I know you guys don't like to wait, and as I was always taught, better 20 minutes early than 1 minute late. So here we go. We'll start with some photos and then we'll get right down to business. So this was walking into Fox today. You can see they have this street sign, Fox Square, which is pretty cool. And then let's see, what else do we have here? That was also in front. And then that was playing golf with Brendan Ahern, who runs the $5 billion China tech ETF, KWEB. Invited me down to his course, and we had a great time. His son joined us, was absolutely spectacular golfer, by the way, on the club champion board for juniors. Pretty amazing stuff. So we talked life, we talked business, we talked a lot of Baba, we talked a lot of China, and then my friend Andrew and his lovely wife hosted a gorgeous party in Connecticut this weekend. At their place right on the water, and they had a boat taking us around, seeing all the Gilded Age mansions right on the shore. It was literally like a Great Gatsby party. They did such an incredible job, beautiful live music, playing older music, and that was the view. There's a couple of these barrier island houses, etc., and just absolutely second to none. This is Annabelle doing braiding on Barbie. No meets this week, and but they're really rocking it out in California. And we'll go to a big water polo tournament in Mesa in a couple of weeks, so I'm excited to be out there. By the way, any potential clients that want to meet while I'm in Mesa, Arizona in early October, reach out. I'm also going to be in Dubai visiting a client in December, and Dallas in early November. So definitely reach out through the website, hedgefundtips.com. Click on contact. Always love to meet people in person. Always love golf too. That's an option if you want to throw it out there. And also, while you're there, click on terms. This is all opinion, not advice, as always. So let's see here. I want to start with some media. And on this morning, I was able to join Stu Varney on Fox Business. So I want to thank Christian Dagger, Preston Mizell, and Stuart Varney, as well as Lauren Simonetti, for having me on the show. We're going to talk some Fed stuff. We're going to talk some Intel developments and some Bank of Japan. So we're going to listen in here.
142. Thomas Hayes joins me this morning. What do these retail sales numbers mean for the market, you think?
Well, I think it shows a continued resilience of the economy, a continued resilience of the consumer. I think as it relates to the Fed, which is the big question for this week, it probably gives them cover to just start with 25 to get their feet wet tomorrow, 25 basis point cut versus 50.
Does it matter? 25 basis points, 50 basis points? Doesn't really matter that much, does it, if the downtrend is in place after 4 years of nothing?
I think you're exactly right. I think that's what they're going to do. The big thing, though, that very few people are paying attention to, what they're paying attention to is 65% chance of a 50 basis point cut tomorrow. That's in the Fed funds futures market. I think that's a little bit aggressive. The key thing this week is not so much what happens on Wednesday, what happens on Friday with the Bank of Japan. If you remember, in early August, the Bank of Japan hiked when the Fed didn't move, and that created a liquidity mismatch, and the Nikkei fell 25%. So if the Fed goes 25 basis points, the Bank of Japan needs to hold pat and do zero. If they go 50, the Bank of Japan can hike 25, and things will be okay. But you don't want a situation where the Bank of Japan starts to unwind that carry trade again by going more aggressively than the Fed in the other direction.
It's just getting very complicated, isn't it?
Yeah,
Looking at the Bank of Japan to the Federal Reserve, 50 basis points, 25.
There are a lot of assets.
Well, I think the bottom line is that stocks go up. Typically, the S&P goes up 13% in the 6 months after a rate cut.
Okay.
So
Exactly.
If you're doing well in the market, you'll continue to do well.
I've got to deal with this. Last time you were on the show, you said that Intel was worth buying. And at that time, it was what, 19, 20 bucks a share?
Yeah, everyone was hiding under the desk. And during the break, he said, Tom, what do you think? I said, absolutely buy it. It's trading at tangible book. If they liquidate the thing tomorrow, you get your money back. Oh, and by the way, there might be upside. People are talking about Intel like it's going out of business. This is a business that did $50 billion of revenue in the last 12 months, and people are worried about solvency. I'll tell you what, 3 big announcements since we saw yesterday. They're partnering with Amazon for AWS to do an AI customized chip. They got $3 billion contract from the Department of Defense, and they're moving the foundry business into a subsidiary so they can raise outside capital without diluting the shareholders.
So buy it at 21?
I like it at 21. I like it at 20. I like it at 19. And it's going to 30, 40 plus over time.
Okay. Thomas Hayes, thanks for being with us.
Thanks for having me.
Always. Coming up.
And we're back. And then we're going to move on to a little bit of technical analysis here from Slumer over at RBC. Thanks to my buddy over there. So it's very interesting, and I'm struggling with this a little bit. It's kind of playing out according to plan. If you remember, we had talked about and showed the election year seasonality where we were hoping to get some strength and start to touch on new highs by mid-September, which would be coincident with the first cut, buy the rumor, sell the news, and then election year seasonality, choppiness into the end of October before a year-end rally. So I went through quite a few stocks, and I was looking, okay, do I want to put a market hedge on? Well, first thing I said is, what's fully valued that we haven't already taken profits? And if you remember, we took a lot of profits in July from the Mag 7 before they rolled over. We took a lot of profits from the banks that had gone up a lot. We went over all that stuff a couple of weeks ago. So I kept looking stock by stock, and I was like, there's nothing near or over intrinsic value that we want to sell into this, quote, predicted weakness that may be coming in a few weeks. So then I said, all right, so then why don't I put some spreads or some tactical shorts on the indices? And I went through I figured the easy ones would be the SMH, semiconductors, maybe QQQ, maybe XLK, tech-centered stuff. And yeah, they're a little stretched, but they're not really at extremes, pound the table, like when we wrote that article about NVIDIA on June 20th, which was literally the top, and it fell 30% right after that. There's nothing like screaming obvious. That doesn't mean they all can't go down in the next 6 weeks. But the risk reward is not perfect. And when I started to look for, okay, how else could I express a tactical short or a short-term hedge for the next 6 weeks, honestly, in looking at hundreds of stocks, the only ones that I saw that looked imminently aggressively shortable were utilities. And as you know, we were pounding the table last fall to buy utilities when no one wanted utilities, and now that they're up 50%, everyone wants utilities. Now you say, Tom, that sounds crazy. If they're going to cut rates, utilities should keep going up. And that's something that I'm thinking through, and I agree with in terms of longer term. But I think in short term, I think a couple of things could happen. One, it could certainly be buy the rumor, sell the news in terms of utilities. Second, the other thing that I started to think about over dinner was, hypothetically, if they did 50 and people got past the shock effect and they started thinking, oh my goodness, the economy is going to grow faster than we expected because they're front loading all of these cuts, versus an interpretation like, oh, they're doing 50 basis cuts, the world is coming to an end, they must know something we don't know. But let's just assume they did 50, which I'm still in the camp they're going to do 25. But if they did 50 and then the narrative shifted to, wow, this liquidity is going to be massive and things are going to, that would be a scenario where defensives would sell off and rates would tick back up because people would expect faster growth than expected. And it sounds counterintuitive, and you see the longer end of the curve and some of the interest rate sensitives that have had rallies in anticipation of this take a breather. That said, when you're looking to do a tactical short to protect against the overall indices maybe coming in a little bit for a seasonal period, defensives is not really what you want to short, because technically if the market's going to correct 5 or 10%, defensive should stay strong in that environment. And looking across hundreds of large cap stocks today for some themes, the 10 or 15 that I said I could short today were all basically in the utilities and REITs groups, and that's not the way to do a tactical short or a hedge. So with the inability to want to sell anything because it's not anywhere near our predefined fair value or euphoric value, where we'll sell some of it as well, and the Mag 7 not recovering as aggressively as I thought it might into the cuts to reshort or sell off, etc. The risk reward to allocating 1 or 2% capital to shorts as of today is not as attractive as I thought it might be going into the first cut. Again, it doesn't mean the market won't pull back 5 or 10% between now and the election and then rally back and then some before the end of the year. But I would like to see a more extreme situation. The other thing we have in hand, which we're going to discuss, is the Bank of Japan meeting on Friday. And it's widely expected that they are going to hold and do nothing. So if the Fed cuts 25 and they do nothing, like I said with Stewart, that's probably a reasonably bullish setup. If the Fed cuts 50 and Bank of Japan either does 0 or 25, my guess if the Fed cuts 50, that's going to give room for the Bank of Japan to hike 25, which they want to do because their inflation is starting to go. That would be fine. But if the Fed cuts 25 and Bank of Japan hikes 25, I think you're going to have another early August situation. And I think that's low probability. So the context that I'm laying out is the best scenario I see right now, unless we get further strength in the next few days or weeks where some things get stretched and then we can really put high risk, high reward to risk tactical shorts on to dampen some volatility and create some extra cash to go long into the election. I think right now the best risk reward is just to hold great companies with low leverage that we love and do nothing but sit on our hands unless we plowed through new highs in the next few days or week, at which time we would take 1 to 2% of equity capital and get some shorts on. But I would say that's, a coin flip at this point. So that's how we're thinking through this. And I guess the answer is, after this beautiful week here, and we've got a lot of gains in the last week, expect some bumpiness and volatility for the next 6 weeks, but have no fear. Like last year, where we made the vast majority of the gains in the last 6 weeks, it was unbelievable. We made more money in a shorter period of time. It was mind-boggling. I think we're going to see the exact same situation once we get the election clearance. So we'll try to use any weakness as an opportunity to build positions in October and late October. If we get some nice surprise strength in the next few days or week, even though we're moving into a period of seasonal weakness, we may use that for some tactical shorts. But just know we're hodlers and we're cognizant of the period that we're entering. And if the risk reward sets up to do something, we'll do it. If not, we're just going to hold through and buy on weakness and then ride the year-end rally like nobody's business. So that's kind of where we came out, because that's something we've been talking about and it's playing out as anticipated. It's just I'm not finding the fat pitch down the middle shorts that I had expected to find at this time, which tells me when everyone's looking for a correction, you may not get it. And for all we know, you get a 50 basis point cut. Yeah, people will cry foul as far as possible political interference. There will be a lot of talk about that. but it may lead to the market going up straight up into the election, which would absolutely surprise everyone, and no one is really positioned for based on some of the sentiment we're going to talk about. It would go against all first cut history. It would go against all election year seasonality history. And that's what the market is designed to do, fool most of the people most of the time. And based on me wanting to put on tactical shorts today, looking at new highs in the Dow and looking at this and that, and not finding any fat pitches, it tells me from looking under the surface that it may not be as obvious as everyone is expecting, and it may actually fake some people out. So we'll see. The beauty is looking at our core companies. We run a concentrated portfolio. What we're excited about is we really don't care what the general market does over the next 6 weeks, because none of them are close to our intrinsic value targets that we defined before we even got into position. All wars are won before the first battle is fought, and they're just moving slowly, steadily, some quickly, some slowly, in the direction that we had intended at inception. So we're excited about that. Let's look at the general market here. So it's up against a Fibonacci extension, which implies that it should do what the seasonality implies, which would be kind of come off that strength. It doesn't preclude it from actually busting through to the next one either. And so you see that. You see a lot of these coming up against the resistance where, cup and handle, and you break out, you're going to keep running. This is on the daily chart. This is the NASDAQ. So this didn't get up to new highs, which could imply it's a head and shoulder top or whatever. And it's just going to roll back down to the shoulder line and either break or reject it. I would love to see this get back to retest that, and that's would create some fat pitches for us, but it doesn't appear that that's in the cards. Maybe it moves up to here, but in other words, we got the strength back by mid-September, but we didn't get enough of it to create fat pitches to get shorts on into the October weakness. So that's where we are. Then if you look at the equal weight index, it's just breaking out, which is also what tells me that when I looked under the surface, why there was little to do from a short side, which is perfectly fine with me, and so on. Even the mid cap, it's just barely breaking out. That's usually not where you see a big correction from. It's usually where you see it keeps pushing higher because of all the disbelief. Same with small caps. If small caps had gotten up to here, I would have definitely expected to check back. It hasn't quite got that mid-September strength, which, everyone is so convinced that we're going to get the worst 2 weeks of the year, which is the last 2 weeks of September. Then we're going to get that weakness at the end of October into the election. And maybe this time will be different. But that's the analysis that I'm coming to here. Even Tokyo didn't regain that. So we'll be interested to see. I mean, Tokyo, they could hold pat and this thing could rally back up. If they start hiking at the end of the week, then this thing could break down. So exciting stuff here. But looking through the portfolio for clients, I don't see any of them that are over, even if they weren't at our full value of where we would want to take some off and harvest some profits like we did in July. None of them are at the intrinsic value that we anticipate we're going to get from the businesses over time. So I wouldn't want to create tax events just to avoid short-term choppy volatility for a period of 4 to 6 weeks. That's just silly, and we're not going to do that. So Hang Seng Index still churning here. Broke out, back tested, starting to work its way back up. We're going to talk about some of the things that are going on there that we're pretty excited about. City Economic Surprise Index, this is turning up. That's not what you see at tops. That's what you see at your bottoms. 10-year yield is rolling over. So we'll see. It's interesting. And that's the other thing that I was seeing. You're seeing it's oversold here. So I'm like, gosh, if they're cutting and yields are compressed, what would cause the 10-year yield to go up? And that would be they expect growth to be higher than anticipated. Now, you did see the GDP now come in at 3% today. the other thing I think it would be a surprise 50 basis point cut or a 25 basis point cut saying we don't, something to the effect we didn't want to do a big cut before the election, or they'll say it in a different way. They'll just say like, we're watching inflation, but if inflation keeps going down, we intend to front load at the next meeting, which is code for 50 versus 25. And then on that rhetoric, the market might start to say, well, the economy is not in an emergency, but they are going to push to do more, which means growth is going to be higher than expected, which means yields on the 10-year, even though the T-bills yields are going down, on the 10-year would start to go up, anticipating greater growth, which would favor cyclical, small caps, all that stuff. So I could see a scenario where yields actually spike on the cut, which makes no sense. But again, buy the rumor, sell the news. This does look like it's breaking down. So it'll be interesting the next few days. But now at least you see what I'm thinking. But this is an interesting divergence that Slumer points out here. 10-year yield making new lows, but you have this RSI divergence, meaning a higher low. And usually when that sees happen, yields reverse. So I wouldn't be surprised to see the TLT go down, which is we talked about weeks ago when we took profits. TLT go down, yields go up, a counter trend move in the short term on this first announcement. Even potentially a counter trend move in the dollar is a possibility as well, because it has moved down a lot in anticipation. This is, again, here, this fib level or whatever, and we could get a counter trend bounce. We'll see. We want to see the Canadian dollar break this downtrend. I wouldn't be surprised. Let's assume the Bank of Japan does nothing on Friday. You would get a bounce off this head and shoulders up, meaning yen weaken against the dollar in the short term, which would be bullish for risk assets, which might take Mag 7 back up, at which point we'd probably put on some tactical shorts if it got up in the next 2 weeks before October, and then we'd have like a 4 or 5 week short. So again, we're paying attention to all this, but at the end of the day, it doesn't change our view on any of our core positions. But it is an interesting time. It's playing out as anticipated, but not with the level of conviction where we would want to take the other side yet. Copper, if you anticipated growth was going to reaccelerate, it could be a story. If China was going to do a major stimulus, they would 150% wait for the Fed to start easing. If Bank of Japan was going to start hiking, they would 100% wait for the Fed to start easing. So the other thing is the Bank of International Settlements said that, which is the central bank of central banks based in Switzerland, in Basel, Switzerland, that for warning central banks not to squander the buffer that they've built up. In other words, save some bullets for when there's a crisis, don't cut too fast, which leads me to believe they're going to do 25. But if they did do 50, I think after the initial knee-jerk, people would say, oh my gosh, growth is going to be much faster than we expected, and no one's positioned for that. Everyone's positioned for slow growth, all crowded into defensives like staples and utilities. Cyclicals are left behind, and I think cyclicals are ready to run, and small caps are ready to run. Whether that needs a 50 basis point or a 25 with hawkish talk, if they did 50, that means Japan can go now. And if Japan can go now, that means you're going to also see, besides the yen, you're going to see the yuan start to strengthen. You're going to see Chinese bond yields go up. And that's usually when Chinese equities do well also. So a lot of and what's really interesting about all that talk that I've just spent the last 22 minutes with you going through how I'm reasoning through all this, it has zero bearing on what we would do relative to the beautiful companies that we have in our portfolio. So nothing really changes other than getting cute in the short term, which, we would only do if we have like 5-to-1 risk, 5-to-1 reward to risk trades that we could put on short term with 1 to 2% of equity. And they're not present yet. So we're not going to force it. Other than that, yeah, you can see all these are kind of just in ranges, not exciting long or short. So Pfizer, we've talked about over the past. This looks like it's working its way higher. Alibaba, same story. Looks like the fib retracement would be at 120. Sooner is better, ladies and gentlemen. We're perfectly comfortable with sooner. And if you look back through history, when these things finally break through, I'm just watching this 90 level like a hawk. When it breaks through that, I think it could go straight to 120 very, very quickly. And it could have something to do with these Feds. Look at PayPal, same exact chart. It's happening like crazy right now. Gotta love Alex Chris and all the things he's done. I mean, this thing was down at $50. It's now 72. And the fib levels, according to this silly calculator they have, start at 110. This thing is definitely going to be a double plus over time. And we're excited about that. Even Disney's coming off the mat. I mean, is this a stock you short right now because you think the market's going to be weak, or you sell? No, it hasn't even started yet. Do you sell PayPal here because you think the market's going to pull back 5% in it, or Disney because you think the market's going to pull back 5%? I mean, that's crazy town. So no is the answer. That was a great set of charts from RBC at Slumer this week. Let's go through a bunch of indicators real quick. What I want to communicate with this is none of them are at extremes where I would pound the table, want to go a different direction in the market. So we could get some type of surprises in the next week, which leads to strength that no one's expecting, is what I'm saying. I'm open-minded to it. I'm not betting on it. I'm just open-minded to it because of what I saw looking at hundreds of stocks today, looking for some shorts, and on the strength this morning. And I'm not shorting utilities. I mean, if they crash, they'll go down 10%. And I can't make 5-to-1 on spreads on that, so I'm not going to even risk $1. So even the PMO buy all is mid-range by SPX. These are some of the indicators I like to look at. PMO Dow Jones, same thing. Again, they're all mid-range, which doesn't scream short the market, even though the seasonality is getting to the point where you'd want to be more defensive. But it's almost like people did that in the early part of September when it was supposed to be stronger, and now in the late part when everyone expects it to be weak, maybe it's strong. And that, if the market is designed to fool most of the people most of the time, that's exactly what would happen. So that's what we're looking at. Even the bullish percent on individual sectors, there are none. The only one that's at a level where I'm like, oh my gosh, let's start to look for shorts. Like energy is closer to the level where I want to be finding buys, which we've talked about. I think energy is a buy here, but on a company by company basis, the only one I like is Comstock. But I think the group and some of the servicers, but I'm happy with Comstock. I'm just saying those are ready to go. Gold miners may be something to look at in terms of a short. I don't know. We'll see. Financials, we've already talked about that in recent weeks. Still hold regionals, no change there. We took the profits on BAC and C over the summer. Those were great. Real estate, maybe the REITs. So again, if real estate and utilities right here at 100%, and real estate at 93%. If real estate and utilities are the only that are super overbought, that tells me that even though they're cutting, rates are going to go up. Now, what rates are going to go up in the short term? It seems like the 10-year yield. And for the 10-year yield to go up, the market has to believe growth is going to be better than they anticipate. And the only thing I could see happening that would warrant that is maybe they cut more than expected, or you get massive stimulus or some positive numbers out of China, which is also very probable because China has been defending their bonds, their yields have compressed on the basis of deflation. And if they announce a massive bazooka stimulus, you would have expectations of inflation, their yields would blow out, and global expectations of growth, if they get serious about hitting their 5% target, would go back up, and yields would stop trading down as you get further out, which implies a steepening curve because the central banks would still be taking the short rates down. So I think that's a plausible scenario that we have to watch for and be open for and are positioned for. All right, let's get through a bunch of charts. This is biotech breaking out. Remember, we bought down in the hole there. Then we thought we were genius with the thing. Then it consolidated sideways. Then it went back and retested. Then it broke out, and now it's consolidating the breakout, and we think we're going to continue to go higher. So we're excited about that basket. All right, I want to run through these because we've got a lot. What are we at? 28 minutes? All right. So I'll be on Neil Cavuto tomorrow at 12 p.m. Tune into Fox Business as well. Foreign investors dump Japanese equities. Remember, I was telling you guys before August when that carry trade unwind, I said these guys are going to get their heads ripped off and you're going to see the yen strengthen and Chinese equities are going to start to recover and Japanese equities are going to go down. All of that is playing out in fits and starts, and I think that will continue this week based on what Bank of Japan does at the end of the week. So let's see. It's interesting. Semiconductor production by location. China has 24% of global share, by the way. That's an interesting chart. Hours of work needed to purchase a week's worth of groceries has gone down in the last year and a half from 3.75 hours to 3.6 hours. New vehicle production. So this has been the issue, is that we're just not making the small cars and we're not making the small houses. That's going to change. Volumes are going to go up across the board, and you're going to see that coming to a theater near you. Equities typically rally following the first Fed cut if no recession. So very hard to get a recession when you have now Atlanta GDP now just went from 2.5% to 3% for Q3. Whether it's 2.5 or 2.0 or 3.0, very hard to get a recession when you have GDP growth at that level and you have earnings expectations of 15.4% for 2025. So even if they're too optimistic, they're nowhere near negative. Therefore, this would be the most likely scenario, which, as you can see in the blue line, after the first cut, you do get this choppiness the first month or so, which is what everyone's kind of talking about and expecting, ourselves included, which leads me to believe that maybe we get the opposite. And maybe everyone's been too cute for this. Well, we're going to find out soon enough. Here is the US dollar Japanese yen. Again, I can see a counter trend move here with where the yen starts to weaken against the dollar and the dollar strengthens short term. And those would be the things. So here are the sectors that outperform 12 months after. You see financials after the first cut, financials, healthcare. That would include biotech, industrials, a lot of cyclicals. What doesn't do as well? Tech, real estate, utilities, which have all done really well into the first cut. What else does well? Staples, consumer discretionary. This is one I want to talk about a lot. You know, whether it's the VF Corps, the Nikes. Problem is, I can't own two sneaker turnarounds. So we're sticking with Bracken Darrell until maybe Nike gets a new CEO. But dividend yield still cheap relative to history. Value still cheap relative to growth. These are times where generational buys happen and fortunes are made. 2 standard deviation moves. You got to bet with that. Growth versus value, same thing. It's showing that dispersion. Earnings growth for next year. Healthcare is supposed to have the highest earnings growth next year. That helps with biotech. Estimates have stayed up at 280. This is another thing why I couldn't find a lot of good shorts today. This bull bear indicator is nowhere near extreme. Fear and greed, nowhere near extreme. National Association of Active Investment Managers, nowhere near extreme. AII sentiment, nowhere near extreme. So that's not an environment I like to short. High real rates hurting small business sector profits. Very similar to 82, before you had the big rally for 18 years because rates started coming down. That will help small businesses and small caps the most. Here's the GDP we talked about. Mortgage rates are coming down, but purchase applications aren't yet because we need more supply. We're going to talk about that today. Presidential election year seasonality from 1976. We've always done 1955, but this is what everyone's looking at. And you're supposed to have strength in the beginning of September. We had weakness in the beginning of December, then weakness at the end of September, then a bounce in October till a low right before the election. I think this might get a little surprising in coming weeks, and it really doesn't matter, but it's just something to keep in mind. This shows the average PE versus inflation since 1900. So when you have inflation running just 2 to 3% is when you get multiple expansion, and the average for the last 124 years looks like about 23 times, and that's where inflation is kind of sitting right now. It's only when you get up to greater than 10% that you get multiple contraction to 8 times, or if growth starts to slow to 1 to 2%, it would be 18 times. But this is the sweet spot. 2 to 3% was where you get the highest multiple of 23 times, and we're a little bit below that right now. So that's interesting. Empire State Manufacturing started ticking up. Monetary policy viewed as the most restrictive since the Great Financial Crisis. These were times April 2001, October 2008, and finally September 2024. Within months, if you bought, you made generational gains. Most of the dollar weakness tends to manifest in the lead up to the first cut. So that's why I would think that you might start to see a counter trend bounce. New York manufacturing expanded in September. That's a good sign. Inferred freight rates. Everyone's been saying that freight rates were going to balloon in the fall, and that's what was going to throw things off track. They've continued to go down. Empire State Manufacturing we covered. Biggest overweight in defensives relative to cyclicals since May of 2020. If you are a buyer of cyclicals, which we were, those of you, it's funny, someone sent me a note. I've been with you since the Wells Fargo days and the ExxonMobil days. We made very quick doubles on that in 2020. So this is a time that when everyone's plowed into defenses, whether it's late 2008, early 2009, or 2016, or April 2020, where if you got out of defensives and bought cyclicals, you made a fortune. And we did in those periods. So yeah, industrial, and this is how we're lined up. So this is exciting. Buybacks by corporate clients are above 2019 highs. And then this is from Ryan Dietrich over at Carson, which is pointing to the history since 1950. The next 10 days, next 2 weeks are the worst days of the month. So we're going to see if that's accurate, but we actually may have gotten them early this year. That's what I'm saying, is to be open-minded, because everyone is so convinced based on the historical data, and I just couldn't find a lot of good shorts, which tells me that it might not be right this year. Here's the GDP now at 3%. That got upgraded today. And there have been 26 disinversion episodes since 1950, and not all of them have led to a recession. And the good ones to look at are the double dip there in 82, just like we had from 2020. Then we had the recession in 2022, technical recession, 2 quarters of negative GDP growth. I think this is going to more follow that, where you get multi-year strength. Fundstrat out saying when you started September this week, you never wound up with a positive month, 0 for 10. And even if you climb back. So I could see a scenario where we climb back close to even on the month and maybe don't turn positive, but it could also be a different year. A lot of things different have been happening because of COVID, so keeping in mind. Seth Golden points out that only once has the S&P made its annual high in the month of July. Okay. Oh, I see what they're saying because we had a high in July. So 52% of the time, December is the high of the year. So we're going to get the year-end rally. It's not going to be September. Even if we get a dip in October, just hang on. By January 1, you'll be fine. And that's that. Joel Greenblatt, the secret to investing is to figure out the value of something and then pay a lot less. That's what we do here every single week. Here's another chart from Dividend Growth Investor, which is basically what we do here, is we just play the time arbitrage game with low leverage. We buy when it's trading in despondency, well below the margin of safety, and we sell in some at intrinsic value and the most of it above intrinsic value at periods of euphoria. And this time arbitrage is what we get paid for sitting on our hands, provided we did the right work and the right framework here. And that's why you see across the portfolio, so many have popped quicker than expected, like the Rolls Royces of the world. We've gone through a bunch of them. Go back a couple weeks, we went through a bunch of them. And some take longer, but they all work over time because the framework is correct, and that's the name of the game. Small cap stocks beating the S&P 500 this quarter as investors expect Fed rate cuts. That's going according to plan. Here's from Brendan Ahern, ChinaLastNight.com. Alibaba, Tencent, and Meituan are buying their stock. Are you? Bloomberg News reported plan. Okay, we covered that. China internal passport revamp could fuel new China growth. So more of the same. Alibaba to benefit from more cross-border link trading. History of Tencent. So it's showing that some of these companies, when they opened up, like Meituan and Xiaomi in the first, so Tencent gained 23% in the first 6 months after they got Stock Connect. Meituan and Xiaomi doubled in 12 months, which would imply Alibaba, I think it was at 80 when the Stock Connect happened, or 78 or something. So that would imply, 150, 160, which I think is not outside the realm of possibility. I think it could happen that fast because we've had it pent up for so many years and then beyond. So we'll see if it passes any prologue. China to cut rates on $5 trillion of mortgages as soon as September. So what's the significance of September? I think they're waiting for the Fed to cut before they do this because they don't want to have to defend their bonds and their currency. They want those stuff to stabilize, so they don't want to be too easy until other banks start to ease. And there have been 84 cuts around the world. Now the Fed is actually moving, and they may be able to move as well. Z urges efforts to hit their 5% growth target amid rising doubts. Time's ticking. You got 3 months. It's time to hit the bazooka, and maybe they'll be able to do something more aggressive after the Fed moves. And that could be why the market started pricing in 50 basis points this week out of nowhere. It was kind of strange, actually. So we keep an open minded. Chinese chip making shows progress with new EUV patent from domestic lithography champion. Hong Kong, 3.5 billion southbound trading net inflow for Baba. Consumer staple stocks are looking pricey. It's time to sell. That's from Jacob Sonnenschein, reporter at Barron's. And doing a lot of talking lately. I'm going to take a little cough drop here. And we agree. That's similar to the utilities theme. And it's similar to the REITs and staples. Again, everyone's crowded into defensives. Cyclicals will start to work. Why do they work? Because growth is going to be expected to be faster than people expect. And the catalyst for that, we've discussed some of the possible catalysts. China's slowdown spurs calls for stimulus before it's too late. So the pressure is building. China's first retirement age hike since 1978 triggers discontent. So not only are they going to have 20-year-olds rioting on the streets, they're going to have 60-year-olds rioting on the streets with their canes. Lululemon CEO bought up the slumping stock, so he bought $1 million of Lulu. Yeah. Calvin McDonald. So that's one we're watching too. I mean, we can't be too concentrated, but we do think we're going to see a lot of these discretionary stocks turn the corner and turn it quickly, which wouldn't surprise me if it would be sparked by something like China stimulus. I mean, if China did a huge consumption stimulus after the Fed cuts, obviously Alibaba would go through the roof, but Lulu would go through the roof, Nike would go through the roof, which is part of the reason we don't own Nike, because we don't want all of our correlation to be to China. We've got enough with Baba. Okay, so here's the big news that we covered with Stuart. Intel solidifies $3.5 billion deal to make chips for the military. The rumors of Intel's demise have been greatly exaggerated. Boeing labor issue likely to be the final milestone before news turns more constructive. So they'll get this done just like the auto workers did. And then the stock will be finally off to the races. New CEO, everything that you want to see in a turnaround. 2.1 billion net flows to Alibaba in the first week of Stock Connect. So if we expect 30 to 40, I think we expected 20 to 40 is what Brendan was saying on our podcast a couple of weeks ago. At 2 a week, that's 50 in the year. Obviously, the first week will be more. They've been closed the first 3 days of this week, by the way, and the stock is still strong, which is pretty amazing to me. Mainland was closed for a holiday, so there was no southbound connect flows Monday, Tuesday, Wednesday of this week. Keep that in mind. And the stock is still holding up, which is pretty exciting. This was a key article shared from one of our great viewers from GQ. It says it's time to start wearing Vans again. This is dated September 13th, 2024. This is regarding our VF Corp, so you can read that. And then another one from High Snobiety. Vans classic skate shoes look dapper as preppy brogues. I don't know about that, but I do know their shoes are selling because I've been going into a lot of Vans stores in the last few weeks, especially the new schools and everything else. Biden targets Temu with import rule. The beauty of this is it crushes Pinduoduo, and because they have a ton of business in the US from selling stuff at a loss, but that's been funding their ability to compete with Alibaba, which ended last quarter when Alibaba took back share. Alibaba is not nearly as hurt as Temu because their price items are higher, number one, and number two, they don't have huge amount of traction relative to their overall business in the US, like Temu that depends on it, and Shein that depends on it. So Biden hurting Pinduoduo, Temu, helps Alibaba. This is good news for us. The man who made Nike uncool, that's John Donahoe, pissed off all the wholesalers, and they'll probably can him, and the stock will turn around, just like VF Corp. Here's an article from a blog named Dividend Growth Investor. It's from Peter Lynch. He says the companies that do well look out 5, 6, 7 years, and some decisions that they make may not be the right thing for next year. And he's talking about Hubble Inc. here, and he shows how sooner or later the price catches up with the underlying earnings. And we've talked about that for Alibaba. We've talked about that for PayPal and other companies. And it just showed here that the stock did nothing for 6, 7 years, and then it tripled overnight, or 5x overnight from the lows here in 2020, and earnings tripled. So basically, you had the stock triple over time, which was consistent with the earnings tripling. And all that means is, in the short term, the market is a voting machine based on emotion. In the long term, it's a weighing machine based on fundamentals. And this works all the time. This is the framework that we use and we teach over and over and over. Intel's turnaround is working. Buy the dip. That's from Barron's. PayPal, life in the fast lane for PayPal. New partnerships could boost the stock. That's from Barron's. It's amazing how opinion follows trends. This is some quantitative analysis showing that in the 13 times that gas prices have saw a 12-month decline of similar magnitude, The S&P has rallied 18% on average over the next 12 months, which supports our statement, get out of defensives and get into discretionary and these other leopard dead groups that are going to benefit from a lot of the dynamics that are happening in the market right now. Man, I thought this was going to be a short podcast because it was only Tuesday, but here we go. Boeing union negotiators to meet as striking workers dig in. They're going to just start furloughing people and they'll come to an agreement. Amazon tells workers to return to the office 5 days a week. We've been talking about that theme would happen. Intel's latest move for its foundry business is so significant. We covered it with Stuart. Key thing is here, they can do joint ventures like they did with Apollo for $11 billion, I think on the Irish fab, like they did with Brookfield for $30 billion. And the legacy business, which is profitable, which has been getting consumed or cannibalized by the losses in building out the foundries, will be able to be more profitable because they can side finance that subsidiary and do a rev share on the subsidiary or some type of economic agreement on the subsidiary and let the legacy business throw off free cash flow and do it right. So all this is positive. They're going to slow down Germany. They're going full steam ahead with the U.S. fabs, which has the U.S. government's backing. And that $3.5 billion from the CHIPS Act this week just shows that it's backstopped, as was our original thesis. U.S. officials jet to Beijing amid flood of cheap Chinese exports. Big names like David Tepper and Big Short investor Michael Burry are quietly upping their bets on the Chinese economy, with Alibaba, by the way. China seeks a homegrown alternative to NVIDIA. These are some of the companies to watch. Who's going to play a role in that? Well, Huawei is, but Alibaba is, and no one's paying attention. Intel aiming to reverse slump unveils new contracts and cost cuts. Intel stock jumps on plan to turn the foundry business into a subsidiary and allow for outside funding. Intel to make custom AI chip for Amazon. Multi-billion-dollar framework. Multi-year. The other thing that's interesting about the Bank of America survey this week is, excuse me, is that FMS investors that think global CPI will be higher. It hasn't been this low since 2009 when it was a generational buy opportunity. So the outlook, this is all fodder to create for the market to climb a wall of worry. Believe in a stronger global economy in the next 12 months. This is really low. This is like 2009 levels and the market's at all-time highs or near. It's amazing. SMS sentiment improves modestly, but it came back in after the Japanese carry trade unwind, so there's more of that. Cash levels went up. Re-emphasizing everyone's in defensives. Cyclicals are going to start to move. They're underweight tech relative to banks. That'll probably continue for a little while. They all jumped into utilities this month. All jumped out of tech. Everyone wants utilities now that they're up 50%. No one wanted them in October when we were pounding the table. US dollar is still overweight by 1.2, overvalued by 1.2 standard deviations. Euro is undervalued by 0.6. British pound undervalued by 0.7 standard deviations. Underweight emerging market equities by 0.8 standard deviations. Underweight European. Japanese equities, finally, after being overweight by like 1 or 2 standard deviations, is now underweight by 0.2. That trade is falling apart. Staples, overweight by 0.7 standard deviations. We said that's crowded. Industrials, underweight by 1.2 standard deviations below its long-term average. There's opportunity there. This is funny. Utilities is 2.8 standard deviations above its long-term average. That's crazy town. Energy, 1.4 standard deviations below its long-term average. There's opportunity there. Materials, 1 standard deviation below. Again, same thing. Allocations to commodities at 7-year low. Most crowded trades, still Mag 7. It's coming a little bit. Still short Chinese equities. That's going to change. And the FMS contrarian trades by Hartnett. Long commodities, long China, long resources, long tech, which is kind of interesting. Long REITs, long discretionary, we agree. Short bonds, yields go up, which we've been talking about. Short utilities, which we've been talking about. Short staples, short healthcare are the best contrarian plays. Very interesting. As they say on TikTok, what are they saying nowadays? Very demure, or I don't know. I've got 10 and 12-year-olds telling me all this stuff. All right, so article of the week, decision days tomorrow. We went through Varney. We went through everything about the Bank of Japan. Now I want to play the 10-minute clip from Pat Gelsinger, CEO of Intel, on Monday night, explaining these 3 initiatives that I explained in 2 minutes on Stu Varney. Let's listen in here.
Welcome back. Shares of Intel soaring in overtime, now up more than 8.5%. As we just reported moments ago, AWS becoming a major customer for Intel's foundry business, including its highest-end 18A process. And the company will set up a separate internal governance structure for that foundry business. Now, this comes after Intel announced it was awarded up to $3 billion in additional government funding under the CHIPS Act for the Secure Enclave program. Joining us now in an exclusive interview, Intel CEO Pat Gelsinger. Pat, good to see you. So last time I talked to you a few weeks ago, the stock was headed down. Right now, today, the stock is headed up on the coming together of some of the things that you said Intel's going to do. I got to ask specifically about 18A here. Interesting to see that mentioned with this AWS announcement, because there were some rumors last week about Broadcom and whether 18A was up to snuff and working out. What can you tell us about the significance of this expanded AWS relationship, particularly when it comes to 18A and the readiness of it?
Yeah, thanks, John, and always a pleasure to be with you and the team at CNBC. Well, this is a big announcement today. Amazon's been a partner of Intel for many years, but we've just taken it to a whole new level. Obviously, the 18A foundry agreement for their AI networking is a big deal. And Amazon is a discerning customer. They are, really sent us through our paces to prove that 18A is up to snuff. And it's up to snuff. And that's part of the announcement today. We also announced a custom version of Xeon 6 that we're doing with them. And together, these two really emphasize the better together, both the foundry progress as well as the product's momentum. But I'm particularly proud, as you suggest, that this really shows the momentum of 18A. It's healthy, it's making great progress. And as a foundry, we see a numerous set of customer pipeline opportunities in front of us, a very big day.
When can we expect, I'm not expecting a date because I don't want to, you had a big announcement today, so I'm not trying to press you but when can we expect more 18A deal type announcements that might give investors confidence that this isn't just a one-off?
Yeah, and as we said, some customers are reluctant to give their names because of some of the competitive dynamics, but we've seen a large uptick in the amount of customer pipeline activity that we have underway since we released the PDK, or the design specs that customers could start to use. So I do see that we'll have a number of these that are making good progress, and do hope to be able to make additional announcements in the future. But the momentum has definitely increased since the July release of the PDK, and the AWS announcement today was just a proof point of that momentum, and we're looking forward to even better things to come.
Okay, Pat, now I believe the Intel board met last week, was it, to discuss a wide range of things, and you're coming back saying you are pausing some of the manufacturing build out in a couple of places in Europe here, presumably to preserve cash. And, you've been a target of criticism for the scale and speed of this manufacturing build out. Did the board endorse the overall strategy of continuing this foundry and manufacturing build out?
Yeah, and overall, it was a very important board meeting, and I and the board are aligned in the go-forward strategy for Intel Foundry. And as we looked at that, it was very important to say we're moving to this next phase of the foundry journey. We had this pace that we needed to go through to catch up, to get back to a competitive process technology, to build some capacity flexibility. And as we move to this next phase, it's much more about building efficiency into that and making sure that we have good shareholder return for those significant investments that we're now seeing the end of the tunnel, as we say, 18A's health. And so what we've agreed is to be very focused on the efficiency of those capital investments, focused on the U.S. Investments first in Oregon, Arizona, New Mexico, and the Ohio project. And we're pausing our European and Germany and Poland for 2 years and pausing the Malaysian project as well. Obviously, we've built flexibility so we can scale up. But first, it's show good financial return from the investments, great support from the board of directors. When we started this, John, this was a 3.5-year journey that we started aligned, we reviewed that thoroughly, and we're committed to the future together.
Okay. Now, you're in a cost crunch right now. You've been cutting workers, now delaying these expensive capital projects. There's been, especially since earnings, a lot of criticism of you as a CEO. Are you confident that you and the board are on the same page on your future at Intel?
We've gone through a very intense time and reviewed the strategy, and I'm committed, they're committed, the partnership is strong. As we finish the board meeting, we clearly have laid out these steps in the future. And today's proof points, the Amazon partnership, the secure enclave, the foundry subsidiary, agreeing and seeing the great progress that we've done on these cost measures. All of these align us to the future that gives not just finishing the journey that we started together 3.5 years ago, but also assuring that we have the financial wherewithal, the balance sheet that allows us to finish what we started. I and the board are fully committed to that strategy and quite confident that with today's proof points, we're well on our way to fulfilling exactly what we've laid out to do together.
Pat, it's Morgan. It's great to have you on the show. I want to go back to the foundry subsidiary that you just mentioned because you are standing up this independent subsidiary internally within the company. I mean, we've seen the reports in recent weeks about the possibility of Intel considering portfolio changes, the possibility of a split of its product design and manufacturing businesses. What should investors read into this subsidiary being stood up right now?
Yeah, and there's really 3 things that we're trying to accomplish. One is, it is distinct. It has different operating requirements. And for that, a service organization like a foundry is very different than a products organization. And we need to have the operational skills to make that great. But second, customers are also looking for their factory to be distinct from the Intel products. And finally, we're looking for capital optimization opportunities, investment opportunities that are distinct for the foundry from the products. And those are the objectives of setting up a specific subsidiary. But it's clearly better together. And I think the Amazon announcement today reinforces that very clearly. It's a foundry as well as a product partnership with the Amazon Web Services agreements today. So distinct, but better together.
So this is not a precursor to you spinning out that business?
No, distinct, but better together. And we do see that that better together is so important because the wafers, right, the cash flows from the Intel products into foundries is very critical. That's the optimization point for the technologies. But increasingly, as you see with the Amazon announcement today, more customers want to be able to view this as their factory, their manufacturing as well. And that's why setting the subsidiary structure up, having clear governance and more accountability for those external foundry customers is so important as well.
Tell me what this overall you think means for Intel. there's a lot of concern about the data center business, the amount of challenge that that's under, how that affects, margins, revenue coming in the door as you're spending on the foundry and manufacturing side. With these announcements today, how much better do you think those costs and revenues are in balance? And, should we expect more of this realignment?
Well, we laid out following our Q2 earnings call a clear plan on the cost reductions, the CapEx savings, the other cost improvements, the implications that has on headcount, our site strategy. And we're well underway on delivering exactly against that plan. That and these changes that we've made for the overall manufacturing footprint, we're confident that we have the balance sheet and beginning a process of delevering that gives us the ability to finish what we need to from a financial perspective and begin delivering to our shareholders better returns as we go forward. And something that I know that this is very important for us and one that we've spent a lot of time with the board looking at, that we do have the financial capacity to finish what we started. And we believe the steps that we've taken clearly allow us to do that. And we're executing those very effectively and finding good momentum. We're going to finish them quickly and then move on to the next phase of getting back to delivering the best things that our customers want for the future on both the foundry and the product side. Okay. Clearly the product side, redoubling around the x86 franchise for both client and data center. And again, today's announcement with AWS reinforces that, particularly on the custom x86 side of the data center business as well.
And the stock is up more than 8.5% right now in overtime after being up more than 6% in the regular session. Pat Gelsinger, CEO of Intel, thanks for joining us here on Overtime. And we were just talking about the 18A process. Don't miss much more on the chips industry.
And we're back. Alibaba update. Here's some notes from Morgan Stanley. The bull argument, stabilizing e-commerce market share has been seen with gross merchandise value growing in line with the industry in July and August, plus 6%, according to NBS. 2, benefits from technology service fees and site-wide marketing tools should improve monetization rates. We covered that a few weeks ago with CMR potentially growing in line with GMV by 3Q, which would be unbelievable. 3, earnings visibility seems relatively better versus e-com peers due to a manageable low single-digit decline in TTG, EBITDA, and loss reductions from non-core businesses, that meaning they all got to break even or profitable. 4, bulls view valuation as attractive at 7 to 8 times PE with additional capital return, dividends, and buybacks of 9 to 10% a year, aided by near-term fund flow support after the Southbound Connect inclusion. And they go through all the money that came in. You can read this since the Southbound Connect by day and the percentage of volume. And then Brendan Ahern posted the percentage of, now that they're part of the Southbound Connect, you can see how much stock the company is buying back on a daily basis. So there we are. So for instance, here he shows that Baba buyback volume was 14% of the ADR's volume yesterday, on the day that he posted last week. $2.1 billion of net buying Southbound Connect the first week, which again, annualized would be 50. It's not going to be 50, but if it's 20 to 40, it's big time. They bought back, yeah, and it's just showing by day the percentage of the volume. I mean, some days they're almost 9% of the volume. The company's in the market buying all the stock. It's mind-boggling. So great data out of Brendan Ahern. Check out his daily newsletter at ChinaLastNight.com. 5 key points which we covered. Managers are still skeptical, which implies after some normal seasonal volume, markets can climb the wall worried to new highs. 2, managers' belief that policy is too restrictive resembles prior periods that were generational buy areas not to be sold. We've covered these. Fear and greed, mid-range. Again, that's why it's like, God, do you want to be a contrarian when it's kind of in neutral land? And the answer is not really. So, biotech earnings, the equal weight down 3.1, which I'm going to assume is attributable to one or two stocks. And it looks like it's INSM. And it looks like it is Moderna again, PCVX, etc. Whereas the cap weighted are flatter, negative 74 basis points for next year. All right, now I got to go through these Ask Me Anything questions. I will get through as many as I can tonight, and I'll do the rest next week when we have more time. So let's take the first question here, which is, all right, any thoughts on ANF? It's consumer discretionary, which I'm interested in the group. Any thoughts on ANF? You're giving me a stock that just did a 15 bagger and you want to know if you should buy it? No. That looks like a good short. I'm sure the numbers are going to look great. We're just not going to do it. But thank you, Vin. On to the next. And Vin, I'm assuming you're new, so welcome to the podcast. And hang in there. You are going to learn a lot, and we're so excited to have you. And that was great that you sent in a question. We're just going to pass on that one for now. It's already made the move that it's going to make for the time being, and we'll revisit it if it comes in 50, 60%. But we like to buy things when no one wants them, and right now everyone wants ANF, and that's not for us. All right, let's see. AMA question. Red Robin. Yeah, I'm looking at some of these restaurant stocks too. That's from Frank. RED. ROBIN. I feel like there's got to be a washout. There's so much competition, but so this is still cash flow negative, so I'm probably going to be a pass. It's not. It doesn't even look like it's close to turning positive cash flow. And in a turnaround, well, yeah, it's actually, goodness, it's trading like it's going out of business. Let's take a look at the balance sheet. $23 million. All right, so they've got a small amount of cash, $23 million. If this is right, you got to check it with the public filings. And $200 million of debt. I didn't realize it was such a small business. Income statement, revenues have been declining or flat to declining, losing money. I don't really see how they're going to turn around. So you have to see when their debt is due. And yeah, this is a don't touch for us, but maybe it works as a trade. It just seems like a business in secular decline. All right. Let's see here. And a lot of emails. All right. Luke. Hims and hers we've covered before, not for me. All right, let's see what else we got here. All right, Frederick here from your fan. This is Frederick Hammerstrom. Frederick here from your fans at the Beers and Baba Investment Club in Sweden. We're forever grateful for your time, sharing your knowledge. In question, in which type investment cases are you a proponent of building a detailed model of the investment, e.g. with underlying business drivers such as volumes, cost base, et cetera, versus more back-of-the-envelope calculations? We do detailed model on every business that we enter. Back of the napkin is more for AMA. You really have to drill down and do the work. You do the same analysis that you would do to buy a private business is really what it comes down to. How detailed would you be if you were going to put your life savings in to buy one business? And that's the kind of analysis you should do when you buy a public company, even if you're buying 8 to 12 of them. Thanks for the question, and cheers to the Beers and Baba guys in Sweden. Jan Torsten, thanks for all the great content. He's asking about long-dated options. I mean, the key when you do option positions is that you should have a very high expected value. So if you're putting 1 to 2% of equity, you want ideally a 3 to 10x EV, and maybe a blended if you've got 5 or 10% of your portfolio in such instruments, a blended EV of, call it 5x, so that 10% of the portfolio could generate 50% returns. And then, some aren't going to work and they're going to expire worthless. Some of you are going to roll, and some are going to exceed your expectations. But it's the high risk, high reward portion of our allocation that gives us some excess returns. But we expect a number of them not to work. So, but the ones that do work so magnificently that they generate a lot of excess returns. So I would leave it there. And then, wow, I think I got to all of them. Let me just see. Jimmy Jones is saying, is it true that Baba can only repurchase 10% of their shares per calendar? So why? No, they have a buyback authorization. I think it's at 24 billion or something, but they can up that if they're getting close to it. They can up it again. The board can meet and authorize a larger buyback authorization. So it's kind of a meaningless cap that does mean nothing. Okay. Casper Dreiss says, big time listener from the Wells Fargo days. There you go. Thanks for all you do. I was looking for exposure to UK and came across EasyJet. I'm not a huge fan of airline carriers. I'm going to say pass. I'd rather just not do it. It's a garbage business, and with those, you want to wait for crises and then try to. I mean, I definitely, if this was any other business that had these characteristics that you're showing me here, margins recovering, revenues recovering, cash flow recovering, price still down. Well, actually, price is not down. Price is up. Price is doubled off the bottom. So it's kind of already recovered when you're bringing it to me, Casper. Could it go higher? Yeah, but by the time, thing is, it's not a good enough business to buy when it's already doubled off the bottom. Like, you want to buy it when no one wants it, and then the only reason you're buying it is because you think you have an edge that it's not going to go out of business, and you're going to get your quick double like someone else already did before you gave me this idea. So your thinking is correct, but for that industry, young man knows the rules, the old man knows the exceptions. This is an exception. So, but thanks for sending that in. And we're done. So with that said, we'll be back next week, probably on our normal time. And we'll see you then. In the meantime, make it a great one. Bye for now.